Samir, if you're sitting on cash right now, best time to actually deploy it for an Indian investor? And if so, which are the sectors or bets that you would advise?
So first of all, we have in all our funds nearly fully invested. I myself personally, over and above being a large investor in my funds, I had some cash and I invested last Friday, not this Friday, previous Friday, 3 days after, the 2 days, the day after the US guys cut interest rates. And I think from a big picture, every market is a buy, whether it is India, China, US, or gold. And I bought all the four on that day also. And coming to our funds, we are 98, 99% invested. In my long short fund, after this correction, my net exposure, which on average over 19 years is 63%. If I look at month and average, right now it'll be more like 78, 80% net, because I am really going in with you can say all chips in for a year-end rally and for a stopping of this FII selling. But now the question is what stocks to buy. So we are not buying any stock which has disappointed this quarter, even if the stock has fallen 10%, 15%, on the basis that these things don't stop in 3-6 months. It is better to buy stocks that are doing well, even if they are up 5-7%. In the next 6-9 months, we think that there will be a shortage of very high growth names, which also we all need. And therefore, our first group, where we cumulatively have maybe 14, something 12-15%, is all these 4 platform companies, which are Zomato, Swiggy, PB Fintech, and Paytm. And rest, we will buy only stocks.
What's the pecking order? What's the pecking order of these 4?
Pecking order is only Zomato is a real big one. Other 3 are maybe 2.5-3% each. So together, but Zomato, because it's gone up 5-6 times for us, or 5 times, it has become some 6%. So others will be 2.5% each. Or maybe Paytm is 3.5-4%. That also because we made serious money on it. So, but the point is not the pecking order. The point is the concept. The concept is that there will be a shortage in the near future. And we need, not for the whole portfolio, but for 10, 15, 20% of the portfolio, you need something growing 25-30% at a sustainable rate for at least 2-3 years. At least you can imagine that. Then whether it happens or not, we'll see. But it is very boring to buy a company in consumer staple which has disappointed and therefore fell 5%, but its earning growth will now be 4%, and its valuations have gone from 55 times to 52 times or 48 times. Doesn't excite me. It didn't excite me before, and it doesn't excite me now. And one reason why we are willing to play this is because in October, in my offshore hedge fund, actually I was up when the market was down 7.5%. So we are saying let's just play a second round of it and raise the net to the level that we have.